Right now, the foundation of the risk-free bond market is cracking, and almost no one knows how to read what that means. Hi, I'm Kenneth Mraz, strategy specialist at Zang International. The 2- and 10-year Treasury yields have been violently spiking upward. For decades, it's been a topic of debate amongst economists and financial gurus alike. Is it good or bad when we see a major pattern shift like this? But the real danger isn't the spike itself, it's the fact that no one can agree on why it's happening. Are we watching the total collapse of the US debt system, or is the market being hunted by something else entirely? Today we're going to look strictly at the math to diagnose what is breaking the bond market. First, we have to establish the baseline for how this works. When the government needs money to fund its multi-trillion-dollar deficits, it issues an IOU, known as a Treasury bond. To get people and countries to willingly park their money in that IOU, the government has to offer a reward. In the academic world, they call it a yield, but let's call it what it essentially is, the bribe. If the government is financially secure, a tiny bribe works perfectly. But when the system starts to break, lenders don't just want a bribe anymore. Imagine you own a trucking company. If a guy with a perfect driving record wants to rent a truck, you charge your standard fee. But if you look at his record and you see that the last 3 trucks he rented caught on fire, you're no longer charging your standard fee. If he wants your keys, you demand hazard pay because you know his track record is a disaster. Right now, the amount of hazard pay the US government is being forced to shell out to borrow money is violently shooting up. There's 2 realities that explain why the global market is starting to treat government debt like a burning truck. Theory number 1 is the nightmare scenario. We'll call it the Ponzi ledger. Let's say you have a silent partner who borrows your capital. At first, you trust him, but eventually you check his books and realize he's not actually generating any revenue. If he wants you to risk lending him another dime, he has to promise you a massive return. Some analysts believe this is exactly what's happening to the US Treasury. The math dictates that the government is functionally broke. The global lenders have looked at the balance sheet, recognized the liability, and are demanding sky-high hazard pay just to take on the risk of leaving their own devaluing dollars on the table. Eventually, the pool of buyers evaporates, and the only people left to step in and buy the debt is the Federal Reserve themselves. But there's a second theory. I call it the diluted punch bowl. Under this reality, the spike has nothing to do with the size of the debt and everything to do with the intentional dilution of your purchasing power. Think about the math. If you lend the government your money for 10 years at a 4% bribe, but actual inflation at the grocery store and at the gas pump is running at 5% per year, you're operating at a loss. Inflation isn't an accident. It's the system pouring water into your financial punch bowl. So when lenders see the system diluting the currency, they aggressively demand hazard pay just to keep their wealth from evaporating. So which is it? Is the government officially bankrupt, or is the market just trying to survive the dilution? To find out, we don't just have to take a wild guess. We look at the fingerprints that are left on the ledger. Our first clue is history. If you look at a chart of the interest payments over the last 45 years, and we overlay it with the nominal GDP, you'll notice something interesting. Now, nominal GDP is just an academic word for the speed limit of the economy combined with the inflation rate. Historically, the government's payout and the inflation rate act like an object and its shadow. They're married. Most of the time, when inflation runs hot, the hazard pay must go up so lenders don't look like they're losing purchasing power. If the Ponzi ledger was actively collapsing right now, we would see interest rates violently detach from that historical trend. The shadow would completely disconnect from the object and shoot way above the inflation line. But when we look at the chart today, the hazard pay is tracking perfectly alongside those sticky inflation expectations. But we need undeniable proof. So we look at clue number 2, the vault. If the free market actually refused to touch government debt, what would legally have to happen? Well, the Federal Reserve would be forced to step in as the buyer of last resort. They would have to aggressively create new fiat out of thin air, a process that financial talking heads call quantitative easing. But I simply call it counterfeiting the ledger. They'll just add digital dollars into their balance sheet in order to soak up those unwanted claim checks. But look at the Fed's vault today. Bank reserves are actually down from their recent peaks. The Federal Reserve isn't actively printing new base money to absorb these bonds right now. That shows other institutions are still absorbing the debt in the free market. They're just charging a severe premium to do it. Our final clue is the trigger. We have to ask, on the exact days that the bond market started its path upward, what else was happening in the system? Was there a failed Treasury auction? Did a foreign nation dump their U.S. debt? Well, the jump in bond rates correlated perfectly with two very specific events: oil prices jumping and the consumer price index coming in hotter than expected. Someone pulled the financial fire alarm, and the lenders reacted. So the findings are pretty clear. Based on the historical track record and the Fed's bank reserves and the commodity market triggers, the catalyst for the bond market panic isn't a total default yet. The culprit is the diluted punch bowl. Case closed. We maintain course and just try to ease inflation. Right? Wrong. Because if you look closely at that conclusion, you'll see the trapdoor. What happens when the cure for Theory 2 officially triggers Theory 1? Here's the dire reality of the fiat ledger. The government never actually pays off its debt. They just roll it over. Imagine you secured a property years ago with a historically cheap 1% interest on your mortgage, but suddenly the bank forces you to refinance the entire property at 5%. Your monthly liability explodes. That is exactly the chokehold the U.S. Treasury is in right now. During the 2019 era lockdowns, they borrowed trillions at 0%. Now, those claim checks are expiring. Every single month, the government is mathematically forced to pay back old, cheap debt by securing new debt at today's brutally higher rates. Because the hazard pay is so high, the government's interest payments are going parabolic. We've reached a point where the interest payments on the national debt are actually eclipsing the entire U.S. military defense budget. Think about the gravity of that math. We're currently bleeding more capital just to service our past borrowing than we are to defend the country. And because the system operates at a massive deficit, they don't have the revenue to pay that interest bill. So how do they pay it? They have to flood the market with millions of new bonds to raise the cash. But it's a basic law of physics. When you flood a market with overwhelming supply, the value plummets. And when bond values drop, the lenders demand even higher hazard pay. Do you see the doom loop? The diluted punch bowl forces rates up. Higher rates cause massive interest payments. The higher interest forces the government to issue more bonds, forcing the hazard pay even higher. And once the loop begins to spiral, it'll be uncontainable. That is the exact moment the Ponzi ledger officially wakes up. The Federal Reserve would have to pour an entire ocean of water into the punch bowl, possibly hyperinflating the currency and annihilating the purchasing power of anyone carelessly holding fiat cash. It's an equation that ends in checkmate for the consumer. The math is written on the wall. The traditional system is sitting directly in the blast radius of this doom loop. So, as a steward of your own wealth, it leaves you with a very simple choice. Option A, you can continue to act as an educated spectator. You can watch videos like this, know exactly how the fiat ledger is going to collapse, but choose to leave your capital trapped inside the system anyway. Or option B, you can step into the role of the strategist and migrate your wealth behind a physical firewall before the trapdoor drops. Which side of the history book do you want your legacy sitting on? At Zang International, our work is very simple. We look at the foundation of your wealth, find precisely where you're undefended against the fiat system, and assist you in simply moving your money off the fiat ledger and away from the blast radius of a currency reset. Scan the QR code on the screen, there's a link in the description, or call us directly, and check out the videos from Lynette on this doom loop. We're not operating purely on a hypothesis. We're simply taking the proof of what's happening right now and lining it up with the past evidence. Until next time, stay watchful.